and welcome to this very special show and a very special interaction coming up next with me, Ayesha Faridi, Avanne Dubash, Anisha Jain in the studios. When we last spoke with him, October end, he was overweight on India on an index level. Since then, the index also has fallen about 5 to 6%. You've had the Adani saga currently play out. You've had the budget out of the way. And of course, the tightening from the central bank continues. That said, let me welcome on board my next speaker, Mark Mobius, partner Mobius Capital Partners, to talk about where he sees India right now. Mark, hi, good afternoon. Great to have you once again on ET Now.
Good to see you.
Mark, October end when we spoke with you, you were overweight in India, but year to date we've had an FI exodus of almost about $20 billion. What explains this nervousness, Mark? I mean, is it just money moving out of India into markets like China and Hong Kong, or is there something more to it?
No, I think it's a natural movement in the markets. You had a downturn and people get a little scared as a result of the recent problems that you've had with that major company. But otherwise, things are fine. And if you look at it on a 5-year basis, Indian market is still very strong, is still staying up. And I think at the end of the day, it will do well.
Mark, you've gone on record to say that you did not participate in Adani Enterprises stock sale, the FPO that is, before it was pulled. But has this at a global investor level scared or shooed investors away from India?
What happens is that the major investors, the multi-billion-dollar investors, what they end up doing is buying the index. Or even if they're trying to be active investors, they're so big, they're forced into companies like Adani. So in our case, we don't have to worry about that. We're not $1 billion funds. We're millions, hundreds of millions of dollars in our funds. And we can concentrate on companies that have very little debt. And the thing that scared us about the Adani companies, of course, is the debt. So at the end of the day, those foreign investors who were sort of forced to go into these big market cap stocks got burned, and of course they got scared. But at the end of the day, the outlook for India still looks excellent.
Mark, is it fair to say that the exodus that we are seeing with respect to the FI flows will come back soon? Because even before the Adani issue, there was a consistent outflow of FII's money. What do you think explains that? And has it fundamentally changed the view on India with respect to corporate governance issues, etc.?
I look at this outflow very carefully. I have not seen the specific numbers, but you have to count equity and debt differently. A lot of that money may be related to the bond market, the fixed income market, not the equity market. So once you've broken out those numbers, my suspicion is that you're going to see the equity market still strong with flows not going out very big, maybe short term because of Adani. You see some outflows, but I think probably the outflows are related to the fixed income market.
Mark, afternoon. For Indian markets in specific, what do you think is going to be the biggest concern or the biggest worrying factor for us down the line?
I think the biggest worrying factor would be a departure or slowdown of the transformation of the economy that Modi is trying to institute. And that is embedding into the Indian economy technology. I'm not just talking about tech companies, but I'm talking about the economy itself. In other words, having each and every Indian using technology to better their lives. That is going to be the productivity driver for the Indian market. So at the end of the day, that's what I would be scared about. If people say, no, we don't want the technology, we don't want the reforms, then India will be in trouble.
What do you think, Mark, is the best global tactical trade at the moment with respect to how dollar is expected to pan out, with respect to how rates are likely to be? Globally speaking, which is the market that looks the most attractive to you, whether commodities, bonds, dollar? Take your pick.
Well, if you look at the currencies, you'll see the US dollar index has gotten weaker and looks like it's going to get weaker. And the emerging market currencies have gotten stronger. a number of currencies around the world have gotten much stronger against the US dollar. That means that you've got to look at emerging markets, not only China, not only India, but you've got to look at Malaysia, Indonesia, South Africa, Brazil, etc. Because many of these markets suffered an incredible decline in their currencies against the US dollar, but are now strengthening and now getting stronger. So there's lots of money to be made. And of course, the growth story is still very much in place.
In that sense, Mark, would you say that the relative attractiveness of India has surely come down, at least in the near term?
Not for me. I'm a long-term bull on India. I think India is going to do very well going forward. Okay, you're going to have market fluctuations. You're going to have situations like Adani, but the country itself is going to go from strength to strength.
I'm not going to beg to differ there for sure. But tell me, Mark, considering your focus has always been on the non-index stocks outside the index, what is it that you've done in the current market weakness or volatility, if I may put it like that? Because that's definitely hit the mid and the small caps even more. So have you, spotted any brighter spots, any new stocks that you think have emerged in the current weakness?
Actually, we have not really changed very much of our holdings in India, or for that matter, the entire portfolio. But we have been adding companies that are in the software area, companies that are using software, using technology for mapping, for healthcare, and those areas. So that is the emphasis we're using, not only in India but globally, but particularly in India.
You were talking about technology and how that is going to be a big lever for growth in India, as well as the fact that you have technology stocks in your portfolio. Persistent system is one that we know about. Could you explain to us the rationale? And are you also looking at expanding the tech portfolio? There are the likes of Emphasis, TCS, Infosys, etc. as well.
Yes, we are expanding the tech portfolio, particularly in the software area. And by the way, longer term, I think India is going to be a major producer of hardware, technology hardware, chips. That kind of technology is going to come to India in a big way going forward. And I think there'll be great opportunities. India will have its own TSMC someday, I think.
That will be great to have, because at least one thing that we have learned from COVID is the need to be self-sufficient in a lot of things and not to be over-dependent. But, talking about manufacturing in India, there's a lot done with respect to policy action as well, the PLI scheme, the production-linked incentives, etc. Do you really see India becoming that manufacturing hub? And if yes, what's the best way to play it?
I do think that India will become a manufacturing hub. It's already a major textile manufacturer. But going forward, it's going to be transformed more into technology. Now, you already know that iPhones are being assembled in India, but that's the first step. You're going to go back into the actual components, companies making testing of semiconductors, companies actually producing semiconductors, semiconductor foundries like TSMC, Taiwan Semiconductor Manufacturing. So you're going to see a lot of this coming to India, and it's going to be very exciting. So we've got to keep our eyes in that area.
Mark, with the COVID advantage over, what makes you still bullish on the diagnostics names? And I know of Metropolis. I don't know if you have exposure to anything else.
Yeah, that's the only one that we have exposure to in India at this stage. I believe that despite the rundown in that particular stock and some other related stocks, that sector will continue to do well going forward. There, of course, was concern with the end of COVID that these companies would not do very well. But in fact, they continue to expand because the interest in health as a result of COVID has gone up in India. And more importantly, per capita incomes going up means that Indians will be able to afford more and more healthcare, and of course need to have more and more testing.
While you don't have Reliance Industries in the portfolio, you had been all praises for the chairman, Mukesh Ambani. Walk us through, what would really change that, and do you think that maybe you would reconsider?
Yeah, if they're able to reduce the debt and strengthen the balance sheet. There's no question the ambition and the foresight of the leader is quite remarkable. There's no question he's done very, very well. It's just that the debt has gotten too high, and that has to be reduced.
Exactly what played out for the Adani Group as well, right? Because the vision was quite strong with respect to the infrastructure, etc. But it's the debt which actually raised a bit of a red flag. But, Mark, also wanted to get your take regarding the Indian financial system as a whole, because, again, because of the entire conglomerate coming under the spotlight, there is a bit of worry whether the financial system in India would be able to deal with that or not. We've got a lot of comments coming in from the government on that as well. But what's the FII view on that?
Well, the bottom line is that India needs the infrastructure. And I know the last visit I made a year and a half ago to India, I was quite surprised at the degree to which roads, bridges, and other infrastructure was being constructed in different states all over India, which was not very well known globally. But India needs more. There's no question about that. And the degree to which the companies like Adani can grow without too much debt will be very good for India. It'll be a strong point when we look at India. So we need more and more companies in the infrastructure area who are able to do all this infrastructure at a fast pace because it's needed so urgently.
Mark, if I were to just, open the umbrella a little bit, manufacturing now seems to be the dominant theme. We're seeing higher defense, higher railway allocation. This is something that was announced in the budget as well. And these are also very popular choices in the market right now. We've seen a huge move come out in both railway as well as the defense stocks. Is that an area of interest by any chance for you?
Yeah, it's interesting to us, but again, these companies are quite large, and as you know, I like companies that are smaller, that are not so large. But it's not out of the question if the return on capital is very good. One of the problems with the very large companies like that is the return on capital tends to be small, and that's something we're not too happy with. They're doing good work, they're growing, but the return on capital means that they probably will need financing, outside financing, and that results in high debts. So this is something we're not too keen to engage with.
Work well for India is the demographic mix and how consumption could be another growth driver for the country. In that context, the platform companies, the tech plays with respect to Zomato, Nykaa, Paytm, I'm not sure if you've looked at them, but do you see any value in any of these platform names?
Yes, no question. There are absolutely useful opportunities there that we want to look at, definitely.
Looking at perhaps, getting some exposure in them, any top pick with respect to the tech plays, the new age tech companies?
The problem with technology, there's so many sectors. So you have companies like Zomato or Amazon or any of these companies that are doing distribution of products. The problem with these companies is that they tend to have relatively low return on capital. In other words, their emphasis has been to build up their customer base. So they spend a lot of money doing that, but in the process end up with a very low return on capital. We're not too keen on that. Now, of course, it doesn't mean that these companies won't do well, but it's something that we don't want to get engaged with. The same thing is true of the fintech companies. Many of these fintech companies want to build up a big consumer base, so they spend a lot of money on promotion and they don't care about profitability. But this is something that we, being a little bit conservative, are not too happy with. We want companies that are earning money and growing earnings and have a high return on capital and low debt. And of course, high return on capital tends to combine with low debt.
At least with some of these names, maybe. But Mark, tell me, after the recent fall in the market, have you upped your India weightage? Are you buying more of the same?
We're looking, not necessarily buying more of the same, but looking at new opportunities. Because our portfolio is we have a limit of 30 stocks in our portfolio. We have now about 28. So we can add a few names, and we're looking at the tech area.
Do you think that, what do you think rather would be a good way to hedge the portfolio against inflation in terms of looking at other asset classes like gold, etc.?
Gold mining companies would be interesting if they're diversified, not only into gold, because they'll be subject to the fluctuations of gold. Problem with gold, it doesn't earn dividends, but gold mining companies do produce dividends, and that's something we would look at. But by and large, we found that the problems of the environmental problems that mining companies produce tend to make them somewhat risky. So we have to look at that very carefully. But the result of that, we hadn't really put anything into mining companies at this stage.
Does it worry you that in the very near term, looking at the inflationary as well as the interest rate environment, that the attractiveness of share equities as an asset class is diminishing somewhat vis-a-vis fixed income or debt?
No, I think at the end of the day, this is a great opportunity to be in equities because of the doubts that people have with rising interest rates, etc. It's very important for people to have exposure to the equity market, not the debt market, but the equity market. And equities for the long term are always the best investment, in my view.
The budget, the big event was just there last week. And how would you rate budget? And has that opened up any area of interest for you? Anything that stood out?
Not really. I haven't looked at the budget in detail, but at the end of the day, I think one thing you can say about the budget is that the government is keen on increasing the tech exposure of the economy, and that's very good. And that sort of underlines the importance of looking at technology.
What about the outlook on banks? Is it a little bit more cautious, largely owing to the kind of exposure maybe they have to the Adani Group, or in general, are you seeing the overall fundamentals of the financial sector improve, and where within that entire space are you seeing opportunity or continue to remain optimistic?
Yeah, this is a real problem. The banks have a real problem with Adani and perhaps some other problems. The problem with the banks that we have is that they're not very transparent. At the end of the day, if you want to invest in banks, you really got to know who they are lending to and how much they're lending to those companies and people. Unfortunately, they don't reveal that. And as a result, you're sort of flying blind. So I would be very cautious with banks. We usually are cautious with banks anyway, and we don't have any banks in our portfolio. Doesn't mean that the banks are not going to perform well, but we just don't like to be having that exposure.
Talking about country-specific allocation, if I have it right, your allocation to US had dipped below the 10% mark. Is it just because of the market correction, or would you be looking at increasing that as well? How's the geographic breakup when it comes to your portfolio at the moment?
What we do is don't necessarily look at the markets, but look at the companies. And the interesting thing is that the US market has a number of emerging market companies. They may be listed in the US, but in fact, their business is in emerging markets. So if a company has over 50% of its workforce, of its production, of its sales in emerging markets, regardless of where they're listed, we will go into the US market. The great thing about the US market is very liquid. This is one of the big problems that we have in looking at companies in emerging markets. Very often, they're not liquid enough. But in the US, you can find some very good emerging market companies listed there.
Mark, it's been a year and a half you haven't visited India. So when is the next India trip planned?
I have to first visit Saudi Arabia and Brazil, and then Thailand. Then maybe I'll hit India. I'm planning to visit every single state in India. That's my ambition.
I hope you're able to do that, and I hope that's not your preferred list of investments in that order. But anyway, we'll leave that conversation for some other time. But great having you on ET Now, as always, Mark.
Thank you very much. It's a pleasure.
Okay, that's the word coming in from Mark Mobius. Continues to be an India bull, and yes, quite circumspect about the Adani group of names. Completely gave that group and a pass in terms of their investments. 0.5% lower, that's where the index is right now, 17,800, 94 points lower. Idea, of course, is your big star in trade, but MCX, Divi's, Jindal Steel, lots in the red as well. The breath, though, is beginning to perk up, led, of course, by telecom names. But as we take a break at Times Network, we're always looking to create investor awareness and make financial matters simple for our viewers, keeping up with our values. We present the second season of Nivesh Ke Fande. On this edition, we discuss saving and investing, which are both important concepts for building a sound financial foundation. Take a look.
Hello and welcome to another edition of Nivesh Ke Fande. Today we will talk about something that is at the foundation of a person's personal finance journey.
That's right. We're going to look at the savings and investments and the different roles they play in a person's financial portfolio.
Let's start with savings. It's when we keep aside money for an emergency that we can have easy access to. So basically, savings has high liquidity.
Investing on one hand is using money to get some assets that we hope will grow in future, thus helping us grow our wealth.
Well, under the heading of investing, there are a number of different assets that a person can explore, which provide varying levels of returns along with different levels of risk involved as well.
Yes, so investors can pick and choose the investment options that are in line with their risk and reward appetite, and most importantly, their time horizons. So if someone wishes to invest for a short to medium term duration, they can invest in debt mutual funds, and someone who's looking to invest for a longer time horizon in a higher risk product with relatively higher returns expectation, they can invest in equity mutual funds.
And there are many options that would be suitable to persons' varying requirements, and the best part is that people can now invest as low as rupees 100 per month through different mutual funds.
Another point in managing your personal finances is that a person should be disciplined. Being disciplined with savings and investments is important. And through mutual funds, this discipline is made easy as a person just has to opt for a SIP or a systematic investment plan.
Absolutely, and with the SIP, an amount that is decided by the investor is invested at a time fixed by the investor in a mutual fund picked by the investor himself. So in this way, the investor gets full freedom to choose their investment journey as well.
That's all on this edition of Nivesh Ke Fande. Hope we've been able to explain the difference between savings and investments for you. Stay tuned for more such investment insights only on ET Now.
Percent higher when it comes to the mid cap. Some of those Adani group of stocks merit a mention. The likes of Adani Ports have seen a recovery. Take a look at Adani Enterprises, Adani Total Gas reeling under pressure. Meanwhile, you've got an Adani Power as well, which is down about 5% in today's trading session. So keep an eye out on that entire cluster of stocks. But meantime, you've got FPIs that have offloaded equity to the tune of 2,800 crores in Jan, which has been the most since we've seen the sell-off in the month of June. Let's take it across to Sharath, who joins in with all the details. Sharath?
Well, yes, as per the NSDL data, the month of January has been a problem, especially when it comes for FPI selling, hitting its 7-month high levels. Now, the amount coming in is almost 28,852 crore rupees of outflows coming in the equities, where the Nifty itself fell 2.5%. Now, this is coming for the month of January. Now, if you see the last 2 months apart from January, for the months of November and December, there was an inflow of the FPI in equities of almost 50,000 crore rupees. Apart from this, the important sectors which have seen the highest number of outflows coming in the month of January include financial services, where almost 15,204 crores rupees of outflows was recorded, and also the segments such as oil, gas, consumable fuels, that also saw a 10,000 crore outflow, which is also closely followed by outflows coming in the consumer durable segment. But the main question remains is, why has the FPI selling increased? Now, of course, the first reason being the valuations in the Indian markets have been expensive, And the fund managers have also stated that as compared to their global peers, the valuations is expected to shave off. Apart from this, there has been a rout in Adani Group stocks as well, which dampened the market spirits. And lastly, there has been a reallocation of funds coming in, and fund managers tell us to ET now that the fund is being tactically allocated to Taiwan and China, and this is coming in on the reopening theme. And also the important thing is these stocks or these countries have been undervalued.
Well, for now, the market is holding on to 17,750, though the broader markets are clearly outperforming 300-point gain as far as mid-cap index is concerned. It's metals which are under pressure today. IT also is on the back foot, and autos too ahead of key earnings which are lined up this week in on the likes of Hero MotoCorp, M&M, etc. are a bit nervous. What's doing well today is FMCG, led by Varun Beverages as well as ITC, which is sitting at record high levels. Separately, with respect to Adani Group of companies, there has been a definite, recovery when it comes to Adani Ports. In fact, it's sitting at the highest point of the trading session now, with a gain of around 10% since the news of that pledge release has actually been intimated. Separately speaking, on the currency front, rupee has weakened considerably over the last couple of sessions. Today itself, it's seen a move of 1%, and it's now trading what, at 82.60, 82.70 thereabouts? Yes. So almost a percentage move coming in for rupee, and this is ahead of the big event which is lined up this week with respect to the MPC meeting, the outcome of which will be out on February 8th. Globally as well, the picture is not very pretty. You have the US markets in terms of the futures, which are showing a decline of almost 200 points on the Dow, and the Nasdaq futures too are down about 1% in trade, and that's the kind of rub-off impact you are seeing in Europe as well. The indices are down anywhere between 1 to 1.5%, and the Indian markets are also following suit. Kunal, if you had to take an index position at this point of time, what would that be? How should one trade this?
So I think from an intraday perspective, it's very difficult to trade this kind of a market because it's just very, very range bound and extremely narrow in terms of the trading range. 80 points or 75 points on the Nifty, and I think broadly just about 100, 120 points on the Bank Nifty. So nothing much to take away from an intraday perspective. It's just that you have to wait out for the opportunities when the index goes into a swift correction. I think if I can put it that way, because if the stock, rather if the indices get into a phase where you might see an intraday dip coming back, say closer to 17,700 on the Nifty futures, or the Bank Nifty goes to that 41,300, 350 mark on the futures, those are opportunities to try and go for a contra buy. So, but as of now, there are the risk reward is not in favor. The indices are into a range. We are still not crossed above the major hurdle point of 18,000 as well as 42,000 on the two respective indices. So, as of now, the views hold. The positions which you initiated previous week at 17,400, 450 mark, those positions still remain on the indices.
All right, let's also connect with Devang Mehta. And Devang, let's get in your outlook then on the overall trade setup. What's your view in terms of the entire financials basket?
Thanks for having me on the show. I think very clearly there's a polarization which has happened in the market. There's been sector rotation which is thriving. You see FMCG doing someday very well. You see financials probably coming to the fore someday. And again, on certain days, you're also seeing that there is volatility all around. The sense one gets here is that though India's macro fundamentals and micro fundamentals remain intact, but yes, there are certain events which are slated in the global arena as well, which will sort of impact the Indian markets in the shorter term. Financials again being a high weightage in the Nifty should ideally do well, not because it's a high weightage, but whatever you see in the index in the results of say large private banks or even large PSU banks, certain NBFCs, most of the numbers are pointing towards a smart recovery. One, credit growth has been very strong. Second, your NIMs for a lot of banks have expanded. NPA issues now seem to be an issue of the past. Most of this, I think, are right now probably indicating that as the economy grows forward, this sector normally grows at 1.5 to 2x of what the economy grows. And my sense is that consumption, capex plus credit growth can lead to a lot of corporate profitability for this bank. So I think financials should be relatively overweight on at this point. At least private banks, certain NBFCs is where we would sort of put in our money.
Okay, fair enough. That's the view coming in on the overall financial space. In the meantime, just want to check in on some movers within the broader markets. You've got the mid and the small cap indices holding out by 0.5% and 1% or so. Nuresh, let's get in your take then on a Vodafone Idea. Of course, that percentage number looks higher given that the stock is at about an 8 rupee stock. What's your view on M&M Financial given the fact that it's soaring up smartly, and a Metropolis Healthcare as well that's a buzz? Nuresh, maybe you want to unmute yourself?
Yeah. So Vodafone Idea is a clear avoid. There have been such spikes before also on the way down from 16, 17 levels. We saw a spike at 8 also went up to 9. Now again we have gone up from 6.5 to 8 odd levels. So I would still be on an avoid out here. Too early to call a bottom, or rather the risk is high. On M&M Finance, this is something which I recommended in the morning and has been part of my view all through the last few weeks. The stock has broken out into a new 52-week high. A clear-cut breakout. Any dips back to 255 would be a buying opportunity. Stock is headed up towards 300 in the medium term. So M&M Finance still looks extremely positive. The leading stock in the financial pack as of now. Metropolis would still avoid. The stock has corrected all the way from 3600 to 1200. The stock used to be 1150 to 1250 in the lows of COVID. So the whole rally has been removed from the stock, and now we are left with the stock at the same prices where it was in 2019 and 2020. So we'll see oversold bounces, but till the time we can't sustain above the 1400 mark, the trend remains weak.
Okay, for now, 0.5% downtick. Yes, a choppy day regardless. 96 points lower is where the Nifty futures are currently, just holding around that 17,800 mark. Breadth, though, it has to be said, at least within the F&O universe, that's slightly tilted in favor of the advances, with Idea, Indus Tower, Adani Ports, M&M Finance and Zydus Life all holding up in trade. We'll take a very quick break, come right back. We'll track the last lap of today's trading session. Okay, back with closing trades right here on ET Now. Still under pressure actually, about 0.6%, a little bit wobbly there. 98 points lower is where we're currently at for the futures. Breadth though favouring the advances, led of course by telecom names, largely Idea and Indus Tower, which are on a completely different orbit altogether. M&M Finance of course has reacted very positively to its numbers. It's an 8.25% move that you're seeing on the stock. The Zydus Life, which typically is not really an entrant into the list of the top gainers within the F&O gamut, but that's holding up a solid 8.5%. And then, of course, there's Adani Ports, which also has made a comeback, 10% higher, still a long way to go to undo all of the damage regardless. IndusInd Bank, Hero MotoCorp ahead of its numbers tomorrow, ITC, BPCL as well. These are a couple of these names which are actually holding out. But a large part of the Nifty is not. So Divi's, JSW Steel, Kotak Bank, Infi, Tata Steel, ICICI Bank, Reliance, all the heavies are under pressure as we speak right now. Kunal, a word on the index as well before we move forward, because we're coming out of a hugely volatile last week, and this week again, you know, on Wednesday, day after, you've got the monetary policy announcement coming in. So there will be nervousness around that event once again.
Well, yes, there would be nervousness, but the VIX is not showing or indicating any of that. So in fact, on the budget day, just a day prior to the budget, the VIX had shot up to 17.5 levels. We are now almost at 14.7, 14.8 on the VIX. That generally indicates that the expectation of volatility is significantly less as compared to a very similar, rather very recent event like a budget. So probably we can expect the index to remain in a plus minus 100 odd point range if there is no major gap, opening tomorrow. So I think broadly I would expect 17,700 as a near-term support for the index. The only comforting point when I look at the stock specific is the recovery for many of the larger cap names. For example, the likes of ICICI Bank has recovered quite well from 800 to now 850 plus. Bajaj Finance has done exceptionally well. So I think the list of larger cap names which are recovering from their 52-week lows or multi-month lows, that list is increasing, and that could probably add to more of a comfort sign that the markets can hold on to those previous support levels.
So Kunal, since you're talking about gains coming in for the large caps, my colleague was very helpfully pointing out that for Reliance Industries, it's perhaps getting into a range where it was in September, and since then it's seen a big bounce of almost 20%. So it's back at that level, and it's now in the oversold region as per the RSI indicators as well. Do you concur with the view that there could be a bit of sharp reversal?
I would not expect a sharp reversal, but I would expect a very steady kind of a move. So I mean, it's like for someone who's looking to buy Reliance Industries and is looking out for classical entry points and not looking out for too much of fireworks, I think at current levels of 2,300, the stock seems to be finding that major support point. Now, we look out for, Reliance has this tendency of going into big broad ranges for months as well as quarters at a time, and I think if you can try and identify those key support zones and try and buy the stocks at those lower end of the support zones, that makes the risk reward favorable, even if you're looking for a 5 to 10% return over the span of 6 to 8 months. So I think similar could be the seen with Reliance Industries this time around as well. 2,300 seems to be a very good support for someone who has a time frame of 6 months plus, looking out for 2,500 as a target. I think it's a good time to buy the stock.
Naresh, we discussed the breakout in both Idea as well as Indus Tower, but given how meaningful the move is today, just wanted you to reiterate your thoughts on viewers who are just tuning in perhaps.
So in terms of Idea, we've seen this pullbacks of 20% multiple times on this journey from 16 to 6 rupees, almost 6.5 rupees. So would not try to jump in here on a single announcement, would wait it out. On the same side, Indus Towers has something which has corrected on the back of Idea falling only. So if one wants to really take a punt, Indus Tower is the place to be instead of Idea. The stock is available at the same prices where it was in March 2020. And it has corrected all the way from 340, 320 levels to almost 140 in the current fall. So if there is a recovery chance, it is Indus Tower. So going forward, it has made, say, a bottom at 135, 140. So that would be a stop loss. And one would like to buy it closer to 155, 160 zones with a strict stop loss at 140.
All right, let's just pull up some other movers in today's trading session then. And Devang, wanted to get in your thoughts as to what you've made of Paytm's numbers, the fact that they've reported a profitability 3 quarters ahead of that guidance. Brokerages are talking about pretty strong revenue growth down the line, margins doubling as well by FY25. Given the fact that it has been through a fairly volatile and choppy journey so far, can moves such as this undo some of the damage?
I think yes, it's been a sort of overbeaten stock as you rightly said, and it's just a sort of never found gravity as such. The sense one gets here is, though I don't track the stock actively and we don't hold it for any of our clients, the so-called new age businesses who are sort of burning cash and who are sort of valued on price to sales rather than price to earnings. If a bit of profitability now comes to the fore and if margins are expanding, I think there will be some feet which will find on the street and there'll be some buyers for that. As I said, not recommending it as we don't hold it at all and do not cover it extensively. No such firm view. But yes, I think somewhere down the line there'll be a bottom which probably could be formed somewhere here.
Okay, I'm just looking at some of the other big movers on a YTD basis. You have Persistent Systems, the stock we were just discussing with Mark Mobius, which is up 25% this year already. KI is up around 17%. You have Radico Khaitan, which is up 16%. And no surprise, ITC has managed to pile on gains of around 16 to 17% already. And this is coming after the 50% run-up that we had seen in 2022 itself. Even Tata Motors has been very quietly and steadily building on to gains. And this year so far, it's up almost 14%. But when you look at the top losers, it's Dixon Tech, which has lost almost 30% of its equity value. You also have names like Thyrocare, etc. And not to forget what's happening with LIC, because that stock too has been caught in a downtrend, perhaps the pressure emanating from the entire Adani group of stocks, because that too has now been at a 600 rupee mark and now breaking below the 600 rupee mark as far as LIC is concerned. But apart from these stocks, which are the other stocks which are there on our technical experts radar, let's get the BTST ideas going. Kunal, you go first.
So I'll stick with the large cap name Bajaj Finance. That's a buy. Targets revised to 6,250 on the upside. Stop loss at 5,900. And the second one is Ban AB Capital. I think this stock is also making a comeback for itself. Broken past about the 145 minor resistance. So would suggest a buy with 155 as a target. Stop loss at 142.
Naresh, what about you? What's on your radar?
So looking at financials, continue like IDFC, the stock has given a new 52-week high today. A stop loss at 89.50 and a target price of 95. Second is again AB Capital, which has seen a strong comeback in the near term and a lot of financials looking well. So out here, stop loss at 143 and a target price of 152.
Okay. Meantime, Naresh, coming on the charts of an ITC, quoting at about 383 rupees. And what's the view on SBI?
So ITC is now gone from a zone of where it was always a buy on dips to a zone of a sell on rise. The stock has already made a huge move, and the stock has a tendency to go into a sideways zone after such a move. So we recently saw it consolidate from 360 to 330 for almost 3-4 months, and now I would expect from 400 420 would be a very stiff resistance going forward. So one should be looking at booking out profits there, and would expect the new range for the stock to be 360 to 400. So would be an avoid on ITC as of now, or rather start booking some profits in this one.
Okay, those are some BTST trades coming your way. Let's see what some of the other names are throwing out. And, besides the move that you're seeing, of course, on Adani Ports, or for that matter, on an Idea and Indus Tower, it's IndusInd Bank which is actually holding out very, very smartly. I mean, to think of it, even ITC with its blowout set of earnings, or SBI, did not have as strong a reaction as IndusInd is to not the earnings, but just, regularly you are seeing such a move on the stock. SBI, in fact, has completely flattened out now from where it started off in trade. So that lying absolutely flat. The rest of the other banks, like an ICICI Bank, like a Kotak Bank, etc., they're all underperforming. So is HDFC Bank. But IndusInd is the one which is actually charging up ahead as we speak right now. Kunal, IndusInd Bank, Axis still the favorites?
Yeah, I think IndusInd Bank is more of a favorite. Axis Bank was more of a trading play. And I think now ICICI Bank is also coming back into the thick of positive price action. So, what the private sector banks was actually missing out was leaders. And I think HDFC Bank was the only stock which did not correct, but again on the upside it did not manage to give a breakout. But I think ICICI Bank is now coming back to the forefront in terms of the leaders. So possibly that stock can make a comeback. IndusInd Bank, I think, has done exceptionally well for over the last 6 to 8 months. And I think after a bit of a pause as well as a correction, mean reversion, the stock coming back towards its 200 moving average, I think it should also make a strong comeback for itself. So the potential strong breakout candidates which I'm expecting from the private sector banks would be IndusInd Bank and ICICI from here on.
Putting the spotlight on auto income tomorrow is Hero Moto, and you've also got M&M coming out with numbers later this week. We're expecting for Hero MotoCorp the sales volumes to be have been a little bit lower. Price hikes have been taken during the quarter as well, and that'll partly be offset by the negative operating leverage. There's marginal improvement expected in their margins this time around, and that would be driven by the lower raw material prices. Whereas when it comes to M&M, the tractor segment volumes are looking healthy on the back of pretty strong rural sentiment. The auto segment as well has seen an improved supply chain. So we'll be watching out for their commentary as well on the raw material tailwinds, better mix, as well as operating leverage down the line. Devang, let's get in your thoughts. What is it that you're penciling in from these auto majors?
I think absolutely these numbers should be good. Auto sector after a long while is seeing sort of a structural demand, be it two-wheelers, be it four-wheelers, be it tractors, or even CVs. Most of the segments have seen good growth. Typically, if you look at month-over-month sales or year-over-year sales of the festive season demand, for a lot of these businesses have been good. Yes, two-wheelers initially went through that slowdown because of rural not picking up, but the sense that you get while you talk to a lot of rural vendors, a lot of people in the rural area, I think even FMCG consumption and two-wheeler consumption, tractors, all this are gaining good momentum. So it's also obvious in the numbers of monthly sales numbers of this company. So my sense is we'll find a good set of numbers from both these companies which are going to report tomorrow. And in the scheme of things that we are liking the auto sector as such, some auto components as well as certain auto companies which are sort of market leaders in their own domain would do very well as the India consumption, rural as well as the urban consumption, both sort of get a fillip up in the market.
All right, let's start winding down the markets then. Just about a couple of minutes to go to wrap up today's trade. And it has been a little bit quiet when it comes to the frontliners. By the time we wrap up, yes, we're holding on to the 17,700 mark, but it's still down about 0.5% or so. It's the Sensex which is off 300 plus points, but the broader markets that have shone. Mid-cap index up close to 1%, small-cap index 0.5% or so. That breadth as well skewed in favor of the gaining side. Metals have been the worst hit today, 2.5% off on the metals index, commodities, and then IT along with some of the other sectors like banks, which have been pretty quiet and flat by the day's close.
PSE, Media, FMCG on the flip side have done well. Take you through the big losers in trade. Divi's Labs continues to reel under pressure, but a fairly measured fall in comparison to what we saw Friday. JSW Steel, Hindalco, Tata Steel all putting pressure on the metals index. Adani Enterprises goes home with a cut of 2%. Kotak Bank in the red, ICICI Bank too adding to that list. Ultratech Cement, M&M, Reliance Industries, TCS and Wipro, big losers. While Adani Ports gains about 9%, you've got IndusInd Bank in the green, Hero Moto, ITC along with Bajaj Finance. Within then the broader markets, you've got names like Adani Transmission still down and out, Aarti Drugs under pressure, Adani Green, Adani Total Gas as well feeling the heat, while Intellect Design, Schneider Electric along with Mahindra Logistics are under pressure. Vodafone Idea, a clear winner. Indus Stars adding to that list with a solid double-digit gain. PNG Health, by the way, has moved up a solid 14% nearly. Zydus Life, an earnings reaction. LG Equipment, ditto. M&M Finance reacting to numbers. Aarti Industries, Varun Beverages, a whole host of these are result reactions. Paytm, of course, in the spotlight on the back of a healthy set of numbers. You've got MCX hitting a 3-month low intraday, reacting to earnings. Thyrocare, that's another one that's in the spotlight on the back of its quarterly numbers. So those are some of the stocks as well that are in focus in today's trading session. Well, come tomorrow, we'll be watching out for numbers from Bharti Airtel, Hero Moto, Adani Ports. All will be in the spotlight on the back of earnings, and Tata Steel, of course, post-market hours. But with that, we're completely timed out on this edition of the show. Thanks.